Good morning, everybody. Headley here. Really excited to be with you. I love doing these events with TradeThirsty. They're always packed with education. Probably the biggest challenge that you'll have is you'll have so many good ideas. You have to figure out where you start come Monday morning. My objective for you is to say, let's make options trading fit your schedule, whether you like to look at the charts at night, in the morning, during the day, or any combination thereof, based on your schedule, what you've got going on. How about if we focus on not having to panic about worrying about what might be a missed signal during the trading day? So my objective here is to say, let's look at signals. Actually, we send them out on Sunday evening, 6 p.m. Wall Street time. That's what we call it, Sunday Night Trader. And then we're going to get you into the system behind it here today. And then you can decide if you want to place your trade that night, the next morning before the market opens, as we get ready to take advantage of what lies ahead each and every week. As a reminder, just remember that everything that I'm sharing with you today is for your information and education only. Nothing that we talk about here should be considered a specific recommendation to buy or sell any particular investment. Of course, you know that you are 100% responsible for your own investment decisions. Big Trends and staff are not responsible for trades you choose to make, and not all Big Trends products and services are appropriate for all types of traders and investors. As Silas mentioned, every trade has a risk of loss. You've got to go into trading knowing that and making sure you always encourage people to start small and then build up. At Big Trends, we don't provide any personalized financial, tax, or legal advice to any individual. We take our alert signals and we send them out through real-time emails and also real-time text to your smartphone when you become a subscriber. So more on that. And consult your tax advisor always on anything that's going to impact your portfolio from a tax perspective. So today, what are we going to talk about? Well, the key indicator I want to teach you about is something called Donchian channels. On some platforms, they're called price channels, which is interesting because my name, Price Headley, people think I changed my name to get into the investment game with a name like Price, but actually I come from a long line of thoroughbred breeders and owners. So basically, I told my dad when I was at Duke University I wanted to do something more conservative than breeding thoroughbreds for a living. I wanted to trade stocks and options. He thought I was nuts, but it turns out it's a much more risk managed way where you've got liquidity not only to get in, but more importantly, when you need to get out, it's a lot easier to do that in trading and investing than just about any other business, whether you look at real estate, uh, horses, other business buys and sells. Those all take a lot of time. Trading is very much you want out, you can get out. So that's the beauty of this. We're going to also talk about monthly options. And a lot of people, we use weekly options in some strategies at Big Trends, but here we're talking about monthlies because we want to just focus on kind of a more stable approach. And particularly why I love what's called in the money options. Obviously, you want to be in the money in whatever trading strategy you're doing and have more and more of it, right? So we all do. The bottom line is that when you trade options, a lot of times people get turned off by buying options because they buy the wrong option. They buy one that has too much risk, too much time or volatility priced into it, and that's too much decay in that option. We want to get something that's more stable, almost a stock substitute. So we're going to get into that and about how to make trading fit your schedule based on the timing. With our Sunday Night Trader or SNT case studies, it's all about modeling what works and also knowing what doesn't work. When you see certain patterns over many hundreds and even thousands of total trades, looking back over decades, it's one of those things where you really want to make sure that you're positioned to keep learning from that and doing what works and not doing what doesn't work. So once you know a trade doesn't fit your winning profile anymore, get rid of it, move on. So first, monthly options. The monthly options expire the third Friday of every month. So our next expiration coming up will be, 2 Fridays from yesterday, which will be August 21st. Now, with this strategy that I'm teaching about, we're in and out in 5 trading days or less. So it's something where we could trade these. Usually, we'll start looking if we're in the final week before that third Friday. We usually start going out to the following monthlies, which would be the September 18th monthly options. The third Friday of every month being the key. The beauty of this is that these options a lot of times have traded for a lot more than a month or two. They've been around for many months in a number of cases, and so they're very liquid, meaning that you can get in and out easily. And typically, we're doing it on the active names where we've got lots of buyers and sellers. So it's not you against a market maker; it's you against a lot of other traders, which is important. We want something that's got some time premium, but we don't want to pay too much time premium. So that's where we call that extra time premium in the options Greek terminology is called theta. People get concerned about the options Greeks, but just remember theta, T for time. That we're talking about, minimizing that burn rate of the option that you buy. We're not doing any spread strategy here. We're not doing anything that's going to be complex. we're really trying to mirror the stock and create that stock substitute with that in the money option. To me, that makes it much more well suited for swing traders looking out about a week or so. Obviously, if we can get our targets more quickly, we'll take them. And if we hit our stop more quickly, we'll take it. And you say, well, what was the result from following this strategy? When you go back to the beginning of 2019 to now, we just updated this chart at the close yesterday. If you started with a $5,000 account, knowing that we would never hold more than 5 positions at once, so never putting more than $1,000 into any one trade. When you add up all the winners and losers just following our system, we give you explicit entries and explicit exits, and we have it where you can auto trade it through different options brokers even. So you can, this is how we get our actual prices. It's not hypothetical or best case pricing. It's the average entry and average exit price from our auto brokers. You see, the profit would be $6,374 before commissions. Now, one of the greatest things in my 30 years of trading options, I got into options back in 1990, straight out of graduating from Duke at the end of in May of '89, and cut my teeth as a broker briefly and realized I really wanted to do the analysis much more. So I got into an analyst job the start of 1990, and basically, back then an options commission might be $50, even if you were doing one contract. It was ridiculously expensive. Now, as you know, last fall, with the price war between Schwab and Ameritrade, and Schwab ending up buying out Ameritrade, with going to 0 commissions on stocks and ETFs, and options, they took away the commission and only charge a per contract charge. It might be like maybe 65 or 75 cents a contract, depending on what broker you go to. So if you do a one lot, you're talking about less than $1 to get into that, less than $1 to get out of that. So your commissions are actually the lowest they've ever been. It's never been a better time to do options trading, any kind of options strategy, but particularly for this simple one, we're only just buying one leg on the way in, and when it's time to get rid of it, we sell it all at once, whether it's at a profit or a loss or hitting our what we'll call our time stop. So the point being, on a $5,000 account, you'd be up 127.5% going back to the beginning of 2019. As you know, with the market volatility we've had, that you can make money, but then you can lose it real quickly if you don't know what you're doing. And that's what we're big on at Big Trends, is making sure that you don't get stuck kind of in that sort of perma bull or perma bear mode. We adapt to the way the markets are trending. And so now let's talk a little bit about what we're going to look at here today in terms of technicals and charts. And what I like about this system too is that it's not just the blue chips and the FANG names that we would trade with this system. We trade a lot of names that are a little bit off the radar of a lot of other people because they trade well with this system. So everything we do is based on looking back over oftentimes at least 10, usually up to 20 years or more of market data for a given stock, and looking at everyday signals. So you're going to get a lot of potential history behind this. So it's a systematized saying we have an advantage here. Okay, now what are we looking at on this chart? The Donchian channels, let me explain that first. The upper Donchian here, which I'll just call a U for the upper, is this upper green line here. The lower one here is, you can see this lower green line here was put a D for down, or should have put L for lower. But basically what you look at here is when you hit the lower Donchian channel, what that means is that's a new low for whatever the look back period is. Notice when it's going to new lows every single day, we don't want to buy that right at that low when we don't have longer term support or some evidence that we're starting to get some stabilization in the stock. Notice also that we've got this black line here, which is a moving average. This is a longer term moving average. Most of you are familiar with moving averages as defining kind of just a generalized trend in a security. Marsh McLennan as an insurance name, is one. MMC is a symbol, is one that you can see the signal came in early March here. It basically, has been a steady longer term uptrending stock on this chart. And the fact is it's above that moving average. What that means is that we will never try to get bearish on a name that's above its longer term moving average. That's how a lot of traders get their head handed to them by trying to pick tops in names that are generally strong. We would much rather buy the dip in the uptrend or sell the rip in the downtrend. We'll get to some downtrending charts a little bit later. But basically what we also want to see is evidence that there was a major kind of a turning point. And when you see a nice candle like this one here, this flip off the moving average here, means that we opened here on the left side of this candle and we closed about that same level, but we were down here. The low was way below that longer term moving average, and that would have freaked out a lot of people who were in that intraday, and then they're getting flushed out, bailing on it, and the stock's rebounding by the end of the day. So you get a nice reversal like that, and you say, okay, you know what, coming off the moving average, coming off of the, now we've finally seen what looks like a flush and a turning point back up. We're buying that next morning, very close to that moving average support. You can see the stock's trading in the neighborhood here of about 104. Now notice, which option will we buy when the stock's at 104 that next, and we send that Sunday night, so we're buying that next Monday morning, so you've got time over the weekend to take advantage of this. We ended up recommending a 100 strike call, which is about 4 points in the money, but this one was going out further into April. And so, okay, we bought that for $7.15. That means if you bought one contract, which is what our model portfolio would do, saying you can't put in more than 1,000 on that graphic I showed you earlier, that would cost you $715 to control 100 shares of stock. Now, you say, well, why would you just buy one contract? Why not load up? Well, because we are always concerned about capital allocation on any system we run a big trend, so we don't get too high or too low. You just want to be consistent, take whatever your number is. If we would recommend that it's something that's manageable for you at first, and then you can always scale it up from there. Notice that, one of these contracts going up 51% the next day, when the stock popped, that same day it popped up to about 108, and then the next day it traded up to about 110. So that option, the 100 call, has to be worth at least 10. Turns out it was worth in the neighborhood of about 1070 because it had some time premium still in it with about a month and a half to go still. So you see that we're able to book that 51% gain the very next trading day. So in on a Monday morning, out intraday on Tuesday. So we have these orders working to book a 50% gain or better if we get that. So we've already sent an alert out to say, okay, here's your price target up 50%, which when we get filled at 715, we'll send out that follow-up. Says, okay, get out at, whatever it was, 1065, 1070, whatever it was. Well, bottom line is that we also have a stop working at the same time, which is that we don't want to lose more than 25% of what we put into the trade. So obviously, if we lost a quarter of that $715, you're talking about, in the neighborhood of about $180 as about $1.80 down from 715. We're going to be saying, okay, get out in the neighborhood of about 535. So basically, we've got clear stop and target instructions. That's good for you as a subscriber. It's also good for the auto brokers when people set things up, and it's no additional charge at the auto brokers. We recommend to just set it up and have them execute it for you versus what you'd pay if you did it on their platform. That you say, you know what, this is clear instructions for everybody on where to get in and, more importantly, where to get out. It also means that we don't change that target and that stop during the week that we're holding that position. It's much simpler. Just keep that working. If it gets to the target, it gets to the stop, follow those instructions. And we've got at least, in this case, a 2-to-1 size of our reward for size of our risk. Make 50, lose 25. Obviously, what can mess that up would be gaps. So we're trying to avoid gap situations like, say, earnings. We're not going to do the strategy right in front of earnings. You want to minimize your risk. Notice, you see, we got out pretty well, and then, of course, the stock came back down. Why didn't we get in right here? It could have been a consideration, except that we had other opportunities we liked better. So basically, that's one that you could have said that looks like a reversal, looks like it's ready to go. You see it ends up gapping down the next day, and if you were in that trade, you're going to get stopped out probably in that gap down here that next day, but we did not take that trade. So that's where we're always evaluating what has what we call the highest profit factor on the weekend of our system. So here's one, as you know, gold's been red hot. Just phenomenal move we've had in gold. I've been preaching gold as a buy for a long time because it's under-owned by the investment community, and of course the inflation risk is out there. Given that everybody's been saying there is no inflation risk, that it means that everybody's sold based on that premise. So it just has a lot of potential buyers. Now we're getting obviously a lot more of optimism with the big move we've had. Our goal would be not to chase gold on an up move. It's rather to buy the dip after a brief little flush out. So you see Newmont Mining, one of the go-to names, one of the leading components in a lot of the gold ETFs like GDX. Newmont is a main one that we follow in the gold sector. You can see the same pattern happening here. Notice the lower Donchian channel, before we started to see that reversal, looks like it's being broken here. And the question is, when it starts to come back down, is that a sign of a new downtrend here? It would be if we kept on going down. If this next bar had been even lower, then we would say stay away if it's going to break down. But if it's going to turn and flip, this is like that fake out I just mentioned, where a lot of traders are getting faked out on a move, and then you see it's actually coming back up here, and we're saying we want a part of that with that nice reversal here. And you see the gap up actually means we buy it a little bit higher the next Monday morning here, just under 46 bucks. It looks like we actually we had in this case I think it was a 44 call actually for a couple of bucks, and you can see that we ended up popping up here quickly to 50 bucks that very next day. So again, getting the 50% profit. Here's another thing I want to talk about here is that, so we got in at 2, and that's if you're putting $1,000 in, that's going to get you 5 contracts. We're not trying to get cute and sell a couple of them and let more keep riding. We're saying you get your 50% gain, you take the whole position off from 1,000 in, 1,500 back out, you made 500 bucks. Well, now notice what happens from about 50 where we get out, the thing goes up to 52. How many times is something you get out of it and you go, oh man, I wish I hadn't sold it? Don't think like that. With this approach, you're saying take the bird in the hand. We're back into resistance, and you see what happens. It starts popping back down to about 46 bucks a couple days after you're thinking you missed out. Now you're happy sold up there at 50. The bottom line is that even if it keeps going, don't play that guessing game with yourself. Trading's such an interesting game because so many traders get into that guessing game because it seems like kind of a lonely game. It's you against the markets, and that's what a lot of people come back to big trends for, is that not only the validation of the signals and the quality of the system, but also the interaction. If you've got a question, we're always here to help answer your questions. You get a live body when you call in quickly to get things addressed, or to make sure that you're understanding what's happening as you get started. Now, this is an interesting one with Constellation Brands. Notice the difference. Look where our moving average is now. The moving average is actually overhead. Is that going to be a bullish setup or a bearish setup? It's going to be a bearish setup, a negative potential situation, because you can see now we're tagging into this upper Donchian channel. And when we tag into it, remember I mentioned that fake hour, it looks like a question mark is going to keep moving up, and then it flips back down right here. That's our reversal confirmation that says we're going to get in on that next bar's opening here. That's an entry in the neighborhood of about 189. We're buying an in-the-money 195 put. What's in the money on a put mean? It means that you have a right to sell the stock at 195 here. It's 6 points below that already, so it's 6 points in the money. Now, you're not going to be able to pay just 6 for it. You have to pay some time premium. In this case, it costs us 940 bucks. And you see that at first, not much is happening with this trade. Notice it gets down to the lower Donchian channel, and maybe that's support. Then it gets into the upper Donchian channel, or slightly above where we got in. We're actually at a slight loss at that position, but we're not getting stopped out. Why? Because it hasn't moved that far against us. From the neighborhood of about 189, it's moved up to about 191. Maybe it's 2 points against us. That option is not going to go 2 points point for point against you. It doesn't have a perfect inverse delta of minus 100%. It's probably going to move about maybe $1.60 against you. So we might be down in that case 17, 18% on that trade, getting close to the stop, right? But you see then the next day, it pops on down here to just under 184. Remember, you've got a 195 put. It pops down actually to about 183. We're saying, okay, we're going to cash that in. Part of the reason we cash that in is it hits our target, but also as we're heading into 5 days, if it hasn't gotten there by the end of the 5th day, we're bailing on that thing. And you can see it's getting right near, you can see count them out from the time we got in that 5th day into the close there. And we're saying, okay, it's time to ring the register. Notice, glad we did, because it snapped way back up, all the way back up to the moving average up here a couple days later. This is where proactivity really pays off, because you don't want to just get complacent and keep holding and hoping you get that bigger move. Obviously, we've had some great big uptrends here off the pandemic lows, but our view, especially as we're into the summer and into the fall coming up and with an election ahead, is I think you can start planning for some choppier trading, and this is going to take advantage of that back and forth chop even better. We've been doing well just fine with this uptrend too, mainly buying dips in uptrends on calls, so we're not going to fight that. But when we get opportunities, we'll take them in either direction. And you can get one opportunity, you could get 4 or 5 opportunities on a given Sunday nights. You just never know where the system's going to say we should be pounding the table, or we should be waiting a little bit for the next better setup. Mondelez, maker of Oreos, among other snack brands and other kind of household eats. You can see so one of my favorites. It's slow and steady, and the options are cheap on Mondelez. So basically, everybody's out there trying to buy these tech stock expensive options and saying, you know what, you're paying through the nose on a lot of those. I'd rather take a lower risk approach. Look at this example here. Comes right off the lower Donchian channel, and then it does have that reversal back up. We don't want to buy that big down red bar. We want to wait here for the reversal back up. So we're buying right in here off the open at about 53.5, maybe 53.40. Notice, what are we paying for a 50 strike call? At 53.40, it's worth $340. We're paying $365 per contract controlling 100 shares. So the beauty of that is that you're paying like a quarter of 25 cents out of that 365 as time premium, which is in the neighborhood of what, about maybe 7 or 8% of the total position is time risk. That gives you incredible stability. If this thing just flattens out, you're not going to get creamed like a lot of other traders get creamed buying at the money or out of the money options. Notice that quick move up to about 55 makes that 50 strike call worth about $5. We're getting a 53.4% gain up there a couple days later. Yes, it goes up a little bit more, then it starts backing off. So again, that steady, kind of wait for. Warren Buffett talks about it. The beauty of investing being that you don't have to swing at every pitch. You wait for the fat pitch, as he calls it. That's essentially what we're doing here. Now, I got to show you something that doesn't work too. I'm not just going to show you good examples. I'm going to show you an example where something was awry here, and when you use it on this system that's very steady and consistent, is that when it doesn't work, something worse is brewing. So you've got to take your stop and get out because it's probably going the other way. But we're not going to try to flip a trade around. We're just going to say take the loss and move on. Allstate, another insurance name. Here's an example where you've got the stock trading here as we get. And this was kind of before we kind of tightened our standards on how much of a reversal we needed. You can see it really didn't reverse from the open to the close. It was still slightly red. So that's one that these days we would probably, frankly, pass on. But I got to show you some lessons learned here. You say, okay, look, $120. We're buying a 115 call. We're $5 intrinsically. We're paying $712 a contract. So, look at that. You get one contract on a model $1,000 max entry per contract and per trade, and you say, okay, we took about a 27% loss the next day, because you can see it dropped down to about 117. It dropped about 3 points. Well, what's a 27% loss? You can see in this case, it's this option's dropping about 3 points, right, or even a hair more. We're in maybe a little above 120. So we're, unfortunately, it looks like going down almost point for point on that trade. Maybe not as, I wouldn't have expected quite as much of a hit on that, but you know what? Take the loss and move on. Because basically you say, okay, something's not right. This trade, don't hold and hope for a bounce. You see how brutal it is. And this is pre-pandemic, right? This is late February. So, I mean, pandemic starting, obviously the most of the damage in the broader indices happened in March. But the bottom line is that maybe some wind was, something was in the air as far as, the problems coming for the insurance business in covering possible COVID losses. Who knows? But the point being that you don't want to assume that you know better than the market. You want to say something's not right here. It should have bounced. It's not. Get out, take the loss, move on. You see, if you sit there and wait, you're going to get creamed as it drops down to 104, back up to 115. You're at the money or out of the money at this point, and basically that's something you don't want to just getting not just beaten up by price action going against you, but also time. That ice cube of time is melting as you're waiting and hoping for a bounce. Don't do it. Just cut and run out the next day and moving on to the next opportunity. Okay, how about a bearish opportunity? Pfizer. This was late last year. Obviously, Pfizer's improved dramatically with the hopes of a vaccine candidate that they're in the mix on, getting a nice couple $1 billion from the government to supply a bunch of doses potentially. We're all hoping and praying that they come up with a successful and healthy, effective vaccine for everybody. I think that's going to put the markets and everybody at ease as we get to that point. But in the meantime, you've got to take advantage of this and make money wherever you can on the upside or the downside. With Pfizer, obviously, is a big drug name. You see that when it's bumping up here, this is why we wait. You can see you're hitting the top Donchian channel. You're then trending up, and it's too firm, and then the big gap up. This looks like it kind of lost some momentum, but it hasn't really gone negative. Right about here, we're starting to question, is it about there? But there's a clear close at the low, negative finish right here. So we're in there that next morning. We actually got a little pop up that helped us get an even better entry, just over 38.5. So basically, you see we're paying about, call it 38.60. we're paying 233 for a 40.5 strike put. And a 40.5 strike, you know, if it was at 38.5, that would be worth 2. This one's worth like $1.90 intrinsically. So we're paying in this case about 20% time, about 80% intrinsic value. Notice, because you don't have to pay up to trade a Pfizer in the money option, when we buy this put, it doesn't take much. This stock goes down here. You can see down here just under 37.5, about 37.40. This thing's hitting up to in the neighborhood of about, you can see we need about 3.5, because there's still some time premium. That's got about $3 intrinsic and then some time premium left. We're making 50% the very next trading day. So that's a pretty big move for Pfizer, but the point being that it was about catching that window. This one did keep drifting down. I don't care. I'm happy to take the 50% whenever we get it, one day, same day, next day, within 5 days, we take it and run. Some trades we won't get either. We won't get a profit or a stop hit in the 5-day window. Here's an example of Motorola. I always think of Motorola symbol MOT, but you know, they went away and then they came back. Now it's MSI. And you say, okay, Motorola 155 strike call. Look at where we're getting our signal, right off the moving average and the Donchian channel. That's usually something we really like to see. It's kind of like a double layer of support right here. So that reversal into the close as we're buying that next open right here, we can see it's happening here just over 161. I'll call it 161, and you see we're buying a 155 call, which you know has got $6 intrinsic value, and we're paying 662 as our average entry from our auto brokers to confirm, hey, we're in. Here's our some got maybe 660, some got maybe 665. You know, so the average was 662. You know, something like that. Well, you say, okay, look, it's not doing a whole lot. We thought it would pop on. Our target was somewhere back up in here. You see, things have changed dramatically. And notice what happens with the Donchian channel. It starts shooting down here because, and we got a fairly short-term Donchian channel. I don't give all the settings away for free, but when you become a subscriber, you get all the settings of the moving averages, the Donchian channel, etc. But the point being that you can see it's tightening up here, because when you look back over more recent periods, you can see that it's starting to now firm up as some resistance across that. So I don't have to manually draw these lines anymore. I let the Donchian channel draw my support and resistance in this case for me. Notice, count out the days, and at the 5th day, we're saying not much has happened here. You can see that we're getting out there, and we ended up taking a 16% profit per our 5-day exit rule. So to say, okay, we got an okay. It drifted up and then backed off to the moving average right here, then came back up. This is the 5th day in when we got to say goodbye during that day. So we kind of look for, okay, well, we're back up in the resistance. We're going to probably take it out into that resistance, because we're saying we know that time is basically ending for this trade. Think of it as like a window that's open. That window is now closing for you to, you know, be in that trade. And so don't hang around and then get boxed in on a trade that you shouldn't be in. You see, not much happens later. Chops all around. Probably would have been a slight loss if we just held on to it. You know, we always like to get some feedback from you too about what kind of a trader you are. Type a number 1 through 5 off of these headings, just out of curiosity this morning to see what kind of group we have with us. We get a lot of folks who are either quick trading 1 to 2 days. That'd be a number 1 for a day, or quick trader. A lot of swing traders. Probably that's predominantly what this strategy I'm teaching about is really ideal for, a 3 to 5 day window. But we can get the profits in 1 or 2 days. Obviously, position trading still works as well, 1 to 4 weeks, up to a month. And then, you know, obviously not as many active investors / passive investor in these crowds. You're looking for how to turn over your money a lot faster. So we got a first initial group of responses in the quick or day trade, and then a lot more swing trades come in, a couple of position trades, but predominantly swing trading crowd, which is exactly what the Sunday Night Trader strategy is ideal for. And when we talk about these tools, just to kind of remind you, we use a lot of platforms. I'm using a lot of TradeStation charts today. Thinkorswim is one of our primary auto brokers, along with another group called Auto Shares that does auto trading. And Metastock's another one that's a great end-of-day platform. So moving average, Donchian channel. I haven't talked about average true range. Average true range is essentially how we help set, can we get the profit target achieved of a 50% gain if we get the move from one end of the range to the other. And average true range is essentially a volatility measure. So let's talk about a couple of these. This is our trade funnel. It just kind of points you in the right direction. So The Donchian channel, like I said, on some platforms like Thinkorswim is called a price channel. So if you're looking for it there, look up price channel. It's just saying what's the highest high over your look back period. So if you looked at a 20-day Donchian channel, you'd be looking back over what was the highest high in the last 20 bars or 20 days on a daily chart. Also, we would track what's the lowest low over that same period. It's not using closes, it's using the absolute high and low that was hit. So obviously, when you say the highest price for that security, and you can do this not just with stocks, with ETFs, with futures, with Forex, with whatever you like to look at, but it's going to mark that highest high, and then the lower band marks the lowest low over that same number of bars. So we're not trying to do it off of different intervals of time. We're saying let's be sensible about defining what's the support at the lower channel, what's the resistance overhead at the upper channel. That shows you the stopping points where that stock is usually stopped. Like I said, if it starts to break that and make new highs 2 days in a row, that's not a range anymore, that's a trend. And two bars in a row on the downside, that's a potential downtrend. But this is what's often called mean reversion trading. This is basically trading a range, but we add that other element. So you can buy the dip, but the question is, should you buy a stock that's really getting creamed? Well, we want to factor in this other element of the longer term trend by using a longer term moving average. So when the stock's trading above that average, we're only going to buy that lower Donchian channel, buy the dip. When the stock's trading below that moving average, we're only going to sell the rip, sell the bounce once we see enough of a reversal off of that. So this is basically using mean reversion on a very much of a day-to-day basis, short term, with against a longer term established trend. So it kind of takes the best of both worlds, in my opinion, of short-term noise against a longer term trend. You want to be buying that uptrend when we're still holding it and buying that lower Donchian. It works as a great filter when we add that longer term average in there, because what we found is that without it, you end up buying some free falling situations that you're like, why did we want to get into that? Especially with options, we're using a leverage vehicle. We want to take sensible advantage of how to leverage that approach. That's why in the money options are much more well suited to this than say just using this for stocks. And again, don't buy at the money or out of the money, because you're going to get stuck in situations where if it does flatten out on you, you lose when we might win with an in the money option. So you're increasing the winning scenarios with an in the money compared to an at or out of the money option. So it's like, if I'm in Kentucky, we'll get bad winters here sometimes. I want to get to say Florida in February. A lot of people do, and so we're going to probably pay a premium to rent this house. But still, why would we want to own it for the full year, full 12 months, when we can just rent it for a month and even pay a little bit of an extra premium to be there when we want to be there, when we desire to be a part of that better weather, better situation. Same thing with a stock, better situation for a stock. Why buy the stock forever when you can just rotate your capital to the best stocks, the best climates when it's time to get there? Obviously, when it gets super hot in August and September, you may want to be back north, right? And folks that are down south will pay a premium to get to cooler temperatures when the climate's better in the heat of summer, right? So basically, it's about adaptability, flexibility, and obviously for a lot less costs. Obviously, with the house, you've got not just the house cost, which is a lot more expensive than renting it, but also you've got the taxes, the insurance. If you're in a hurricane zone or whatever, stay safe out there. Bottom line is that it's one of those things where there's too many risks to hold that for the long haul compared to just getting in when you want it and then getting back out and moving on to the next better place to be. Same thing the way we rotate with an in the money options approach. So look at like just the Constellation example we mentioned. If you were buying just even the 65 shares of stock, it would have cost you over 12 grand. If you're buying a 65 delta option, that's essentially like saying that when you buy the option, it should move like 65% of 100 shares. That's kind of the same idea as 65 shares. It's costing you under $1,000, $940. So this one would have leverage potential about 13 to 1. 7 to 1, 10 to 1, 15 to 1, that range is about the leverage that I want to be at for this strategy. So I don't really want the 50 and 100 to 1 leverage with this strategy. I'd much rather say, let's get the more consistent, steady move working for us and take advantage of that with the in the money options. Now, obviously, the big risk when you buy an option is time erosion. So we're always concerned about not paying too much for an option. Most of the time, a good guideline with what we're talking about with the strategy is don't pay more than 1/3 of the total premium as time. So if an option is trading at in the money for $2 and you pay more than $3, you're paying too much time for that option. That might happen in the case of something like an earnings situation or other big news that's coming up. We want to try to avoid that news, avoid that kind of risk, and say it's a lot easier to trade without the event risk. I know a lot of people get excited about big earnings moves, but that's going to create a lot more volatility and frankly a lot more, not just financial volatility, but potential emotional gut level volatility. I call it the Maalox moments, where you're just feeling the pressure in your stomach building from too much gapping one way or the other, and saying, we want to kind of create a more stable experience. And that's what doing this by waiting for the right setup. A lot of traders get out of bed and they say, hey, this stock's up, I want to jump on board. Kind of that feeling of like being a part of a move, being a part of a crowd. What I'm teaching you is sort of contrarian, sort of like, hey, other people have bailed, this situation's good. The risk reward is actually better to be more proactive and buy from those who are panicking out of an otherwise good situation and a longer term uptrend. Same way they get excited about some dog that pumps it up briefly, and we're going to take advantage of that, be ready to pounce to trade it back down after we get those little short-term reversals. So it's getting rid of that guesswork, that wondering what's going to happen next, and saying, let's face it, none of us can predict what's going to happen next. You say, well, then why would you trade? Because we're trading a probability-based system that says that over time, over a large number of signals, we're not looking for a 50-50 edge. We're looking for like a 60-40 edge, 65-35 edge. So you say, okay, 60-40 edge doesn't sound like much. Well, if you played a heads tails game where you say, you know what, you're going to win 60% of the time, lose 40% of the time, even if you lost 4 or 5 times in a row, you should keep on flipping that coin, keep on taking that bet, because over time that law of averages is going to work out in your favor. So it's about playing that over a large sample of trades. That's why I say don't get into Sunday Night Trader as a subscriber unless you're ready to take a lot of signals slow and steady, rather than just saying, I'm going to try to pay for my service on the very next trade. You could do that, but we want to make sure you stay around for the long haul. And so, like, here's an example from back in March, Illinois Tool Works. Again, not a household name, ITW is a symbol. I love that. Sure, I trade the FANG names. Sure, I trade big tech, big biotech, healthcare, vaccine plays. I'm trading all kinds of stuff, but I like trading, these kind of obscure names too, where it's like, hey, there's an edge here. We want to take advantage of it. And by buying in the money, I don't have to worry about liquidity issues, because it's basically a lot easier. We're not moving so many contracts. We're moving plenty of dollars at $7. That's $700 a contract. Instead of buying a $1 option and buying 7 contracts, we think the right thing to do in the strategy is buy 1 contract of the $7 in the money option. This was a 170 strike call with an April expiration. That was the April 17th. So you can see more than 5 weeks to go before that expiration, right at 5 weeks, I guess, in that example. So, we like the crossword graphic here because we're sending it out at 6 p.m. on Sunday night. That's Wall Street time. Everything we quote on times is Wall Street time, which happens to be Eastern time. But you know what? You're saying, look, the Sunday Night Trader graphic here, I love that because it's a reminder that you've got time here, time on your side to take advantage of this. Well, you want to place the trade that night or the next morning, whatever fits your schedule. It's totally fine. We're working this with a buy to open order at 7 or less. What happens if the option opens and starts trading at 750? You don't panic. You say, keep the option working to buy it at $7 or less. If it gaps down and it opens at 650, we'll buy it lower. The point being that we think the risk reward of this trade is good and we want to take advantage of this. So the beauty of this is that once we get entered on Monday morning and get our confirmed entry, we send a follow-up to confirm the profit target and the stop right after the opening prices are given to us by our auto brokers. So, okay, we've got our entry. We're in at 7. You can bet we're going to be targeting 50%, which should be 10.5. You can bet we're going to be targeting 25% stop loss, which would be 25% on 7 would take you down into the neighborhood of about $1.75. So take it down like 525. So you get like a sell it if it trades below 525. Also get rid of it and take the profits if it trades up to 1050. So think of the key elements here we're talking about. There's got to be a catalyst. Friday's action has to show us a valid setup. You know what the setup looks like now. It looks like we've hit down at the lower channel. We're above the long-term moving average, and we've seen then some price reversal to say that we're not just catching a falling knife. So that confirming our expectations. Same way on the downside trades, buy a put if we've seen a bounce up to that upper Donchian resistance and we're still below the long-term moving average and starting to get some negative reversal back down. In the money, that higher delta option, we'd like to use a delta that's typically in the neighborhood of about at least probably 65 or 70, meaning that the option is going to move about 65 or 70% on a 1-point move in our favor. And so that way we're going to also have a healthy amount of time, usually about a month left on average for our typical time risk. So we might hold the option for 1 week out of a potential 4 weeks that it has left. The structured exits are geared around 2-to-1 reward for your risk. 50% profit target on the upside, 25% stop. We do not do a trailing stop here. We don't keep changing the prices because we want to keep it simple for you. You can put these orders in as good till canceled and just have them out there working day after day, and you don't have to touch it, and you let the thing go ahead and hit the target, hit the stop. Or if we say, okay, it's been 5 days, that's the one time where we'll come in as we come into the next trades for Sunday night, headed into Monday morning, saying, okay, if you haven't already gotten out of this, we're still in it. We're cashing it out on Monday morning before we buy these new ones. Never more than 5 trades open at once. The moving average has to agree with our Donchian so that we will not, if we get an upper Donchian channel, you got a lot of stocks at their upper Donchian channel making new highs, touching up. Obviously, the market's been very strong. We're not shorting a lot of those stocks just so that they're upper Donchian channel. They're above the moving average. So you got to be careful about using that moving average filter. And then the 5-day time stop is a nice additional filter to just not get you holding and hoping on something that's just not moving enough. It's not a black box system. You get actually a fact sheet when you become a subscriber where it teaches you, hey, here's how you can plug it in at home. Here's the settings you need to use for your Donchian, for your moving averages, etc. And then we're going to give you weekly video training. I do a weekly video where I say, here's what happened with this position. Win, lose, or draw. So okay, this one worked, this one didn't. Here's what we did. Here's what we're doing for the new trades. Here's what you need to do. So you're always learning while you're earning. So if you came in late, basically, I want to leave a few minutes for questions, but I want to first show you how to take advantage of this very special offer we've got for you here in just a minute. But just a reminder, putting in $1,000 a trade maximum. There's times where we might, if it's over a $5 contract, it's trading 5.5, we'd only buy one contract for $550. We couldn't buy two for $1,100 if we're capping it at 1,000. Just using that example, never more than $1,000 into any trade. If you took all the trades, whether they worked or whether they were losers, add them all up, gains and losses add up to $6,374 since the beginning of 2019. So here we are, just past the July endpoint here. Just updated this graphic here, but you say, it's basically been about a total of so far about 19 months. So you can break it down on a profit per month. You can break it down on a, if you're making, several $100 a month, that doesn't sound like a lot, but that's several percent on a model $10,000 portfolio, or be like 6% a month on a $5,000 portfolio. So you could really be kind of cranking up your potential here and not having to trade a very big account to get started here. So what we always say is that we like to see that one trade can easily pay for your year subscription. Notice the examples I showed you here, usually it'd be $1,000 for a 1-year access. And we've got the special link set up here. It's members. Thanks for posting that there, Silas. It's members.bigtrends.com/Sunday. Note the members dot, it's not a www dot. It's a members.bigtrends.com/Sunday. So you get a nice members access right away. And when you go members.bigtrends.com/Sunday, we're giving you a special 50% off offer here. So we're taking it down here for you on the full 12-month access. Think about that. We're going to average typically 1 or 2 trades a week, at least probably about 60 to 80 trades a year. So if you look at that and you say we do 70 trades in a year, you're talking about in the neighborhood of about $7 a trade. That's nothing compared to the potential in this trade. Which, think about, if you put $1,000 into a trade and you make that 50% gain, you just paid for your full year of service on one trade on a 50% winner. We'll get $1,000 allocated. So you're saying, look, okay, you buy that option for 5 contracts at $2, it's now $3. You're like, okay, I'll sell this 5 contracts times 3, $1,500. Take the $500 difference. You might pay a few dollars in the total options charges these days. It's so minimal compared to what it used to be. This is a beautiful way that you can swing trade, but truly putting time on your side, making options trading fit your schedule, not worrying about missing some kind of an alert during a trading day. I get this all the time from folks that are, we do have intraday services at Big Trends, and that's why we developed this, because so many people said, I'm missing out on that good one. Oh, I can't believe it. I'm frustrated. We want to reduce that frustration and say, now you know exactly what to do. And here's the extra bonus I'm giving you. Whether you do the 1-year special, the 2-year special is even bigger value. For 24 months access, you're getting actually only an extra bump up of another $250 to get the 2nd year added. So instead of $497, it's just $747 for the 2-year package on an average of 140 trades. You can see that's getting your cost per trade even down even more, below $6 a trade. But regardless, whichever one you choose, I'm giving you an extra bonus today, which I know I've only got so much time to start to warm you up to the power of the Don Chan Channel concept. You get my Don Chan Channel boot camp, whether you buy the 1-year or the 2-year package. I'm going to add that in as an extra special bonus for you today. So that'll give you multiple hours of training. You'll get all the fact sheets, all the kind of reasoning behind why we developed this system and how you plug it in, and what the little tips and tricks you need to watch for on winning trades, and also on losing trades, of things to be ready to get rid of trades if they're not doing what they're supposed to do. So when you go to that members.bigtrends.com page /Sunday, I want to just quickly show you something here. We keep it really simple. We got rid of all the other text, all the other stuff, and said, look, you've already seen this. You have a pretty good idea if this is right for you or not for you. If you have questions, always you can call us. You can just call us and say you saw as part of the TradeThirsty offer there. But what we care about is that we're only going to have this link out there for TradeThirsty buyers here for a while. But basically what we care about is that you're happy and understand the service. So notice, you say, I just want to try it for a year, see if it's as good as Headley says it is. I think you're going to be really happy. Like I said, one trade can pay for that half off $497 great value for the next year's worth of trades. If you don't want that one, you're going to click off that, go to the 2-year. That's an even better value, is $747. Whichever one you do, there's no shipping. Obviously, you get instant access to the members site, and you'll be ready for the trades that come out tomorrow at 6 p.m. But more importantly, you can get started with the Don Chan Bootcamp, start learning and being ready to really take advantage of this. You learn this well enough, you're going to be able to start finding more of these opportunities throughout the week, and not just wait on us coming out over the weekend. You can look at it each night and take advantage of even more opportunities. But what I want to point out to you is that green checkout button. When you click it, you'll see, of course, the fields in bold you got to fill in. We ask for your email twice to make sure we get your email right. That's one way we're getting that to you. But also, once you get your PayPal or credit card info in here, you can just say that you saw it with me on a webinar, or that I helped you, whatever. But bottom line is, I want to show you something else. As you're getting ready to review the terms and conditions, you review that, you check on this box that you reviewed that. But if you want to get it sent to your smartphone as well, say, hey, the trades are ready for you, any other updates that we might have Monday morning on targets and stops, you could say text the alerts to me at whatever your number is. We do ask that you tell us which provider you're using. So if it's AT&T, if it's Verizon, if it's Sprint, if it's whatever, you just type in a symbol or type in something that tells us which provider you're using. Somebody told us Cricket the other day. Whatever it is, that's fine. But we want to know, because what we do is T-Mobile, whatnot, we want to put it on different batch lists. We found that gets it even faster out on all the text alerts to all of our Sunday Night Trader subscribers. So you can take advantage of that for just a $497, or you can do the 2 years for the $747. Both are great values and great ways to get yourself started. And like I said, learn while you earn with the Don Chan Channel Bootcamp bonus today, and get that half off to even, you can see more than half off. It's like 60% off plus on the 2-year package. I wanted to leave some time too to answer some questions. So I see a couple of questions here. One came in from Jay, says, how deep do we like to go in the money? Generally looking at the strike prices, what is my determination based on entry? I'm glad you asked that, Jay, because I mentioned earlier about average true range. This was developed by Wells Wilder, same guy that developed the RSI indicator that a lot of people know and love. And he developed the average true range, the ADX, the DMI lines, etc. And average true range is something we use a lot, especially looking back over about the last month's average true range for a stock. What does that mean? It means how much has that moved when you add up all the total movement. That doesn't just include the high to low movement day to day, but Wilder also looked at the gaps. And we find that's really useful to give you a sense of, okay, like Amazon's average true range is like, or Tesla's, I think we were looking at it yesterday, is like $90 a day. That's a lot. And that's why you're going to pay a lot for Tesla options, and we're not doing that here because we're not going to ever pay more than $1,000 a contract to buy a nice in the money, usually, like I said, about 65 or 70 delta minimum option. So you're not going to trade the Teslas and Amazons with this service, and you shouldn't want to if you're concerned about risk and volatility and stomach churn. So we would much rather get this stable, consistent blue chip names that we know are going to have a very little time risk, create that stock substitute, and take advantage of that. So it's a great question. And Jerry said his account requires a stated risk trades only. Is this for me? This is usually the most basic options approval level, Jerry. We're not selling any premium up front. We're never naked. We're always just buying an option. So usually that's that stated risk, maximum risk. So you don't have any theoretical unlimited risk or huge risk on these trades. You have the risk of what you put into that trade. So if you just bought it and held it to expiration and it tanked against you, you could lose what you put into that. We're not going to hold it more than 5 trading days on typically about a 1-month option. So we really reduce that risk dramatically. Spence asked about out of USA text alerts. That's a good question. I think we've done some stuff for folks out of country, out of USA on like WhatsApp or something like that. So I'm pretty sure we can get you that through one of those other platforms. You can email us or call us if you have questions on that, but you can just type in what you've got there for your text alert feature. You know that you don't have to worry so much about missing a time frame with us. You know that at 6 p.m. you're going to get a confirmation on tomorrow night, 6 p.m. Wall Street time, that here's our new trades. 1 trade, 2 trade, 3 trade, 4, whatever it is, we're going to tell you these are the ones we're recommending. And so it makes it really simple, really easy for you to follow. And then Monday morning, right after the market opens, you're going to basically get a confirmation. It's like, okay, so here's the 50% target based on our average entry price. Here's the 25% loss. You can do it off of your own entry too. If you say, okay, I got in what they recommended at $7, you set your 10.5 target, set your 525 stop. You can do that too. So Andy, late, do we use stops? Yes, we're using a 25% stop versus a 50% profit target. So remember, don't just go to members.bigtrends.com, Jaresh. It's members.bigtrends.com/Sunday. So that bottom, you got to have that /Sunday in there, and that's what then is going to pop up what looks like this checkout page that you've got your choice between adding the 1 year or the even best value 2-year package if you want. Click off of that, click onto this, you get the 2 years for $747. I've even had people that said, can I lock in more than 2 years? You'd have to buy it twice. Buy one time for $747, I'll honor you adding it another 2 years on, so you'd have 4 years for just under $1,500. Obviously, it's tremendous value versus a lot of those services that sell for many thousands for just a year or less of access and don't give you, I don't think, nearly the quality behind this. This is what we have as far as the 1 year and the 2 year package there, Jerry. So if you don't, Jaresh says doesn't see the 747, you should see that there's 2 choices here when you go to that page. There's a 747 option on the bottom, and there's the 497 on the top. Good questions. Okay, let me see here. Any other questions I missed here? Yeah, we're looking forward to the Derby there, Jay, on September 5th, Kentucky Derby here in Louisville, just up the road from me in Lexington. And so we look forward to it. Glad you see it now, Jaresh. Okay, so if you have questions there, you can let us know. So the bottom line on this, and then I'll hand it back over to Silas here in 60 seconds so he can stay on time for the next presenter. And you should stay for the whole time here, folks. It's tons of great presenters today. And so bottom line here is this is about keeping it simple. This is about, a lot of people want to overcomplicate the trading process, want to overcomplicate their indicators, want to overcomplicate their option strategies. This is basically about saying, let's substitute for the stock. Let's do it very conservatively and still have a 50% profit potential where 1 trade could pay for a year's worth of access with a 50% gain on $1,000, $500 profit. You just paid for your whole year on 1 good trade. If we're planning to get out in 1 week, Jaresh says, yeah, we'll be out of every trade after 5 trading days. So that's really what we're about. Aren't the nearest month expiry contracts cheaper? You could do like weekly options and they'd be cheaper, but we don't want to be that risky because we want to say, look, let's go ahead and create something that's a more stable base, but still gives you tremendous leverage, compared to the underlying stock. So this is kind of finding a sweet spot that's not the most aggressive, not the most conservative, kind of just a sensible way to get what options are made for, which is smart leverage. Leverage that you can manage, leverage that says, okay, we're not buying in front of big gap events like earnings. We're going to try to take a lot of that gap risk down and just say, let's take advantage of the ones that have the best risk reward to bounce in an uptrend or to sell back down off of a prior bounce within a longer term downtrend. We'll keep it really simple for you. We'll allow you to manage it. And of course, we're always here for you to answer questions. Just go to that page. You'll see you've got your two choices there, members.bigtrends.com/Sunday. You can just tell us you saw it on the TradeThirsty offer too if you're having any questions. You can see we spell out everything down below as far as things you need to know. To click on that, hit your submit order button. You should be good to go, ready to get tomorrow's trades at 6 p.m. Wall Street time. It's 10 o'clock, ready for our next speaker. So I'm going to hand it back over to Silas. Thanks so much for having me today. It's always a pleasure.